On behalf of McCarthy Tétrault, I'm so delighted to welcome you to our 2023 Private Equity Outlook webinar. Now our sixth year in a row doing this. I think this will be a terrific discussion at a very interesting time for the PE ecosystem and just generally in the world. So I'm very much looking forward to today's event. Whether you're a sponsor, an LP, a founder, an advisor, a corporate development person, a portfolio company, or a service provider, I'm sure everybody will take something new out of today's event. So today's event is taking place completely online. We have a number of my colleagues from across the country joining us today virtually as speakers. There's a Q&A tool at the bottom of your screen, so we certainly encourage you to ask questions during the webinars. We'll save some time for Q&A at the end. As a quick introduction, my name is Pavan Jawanda. I'm an M&A and private equity lawyer based in Vancouver, also the co-head of our national tech M&A group. And before joining McCarthy in Vancouver, I was practicing in New York, Hong Kong, and the Silicon Valley, and in a prior life as a CPA as well. So it's been a fascinating couple of years for private equity and the deal environment generally. I think we can all agree with that. Obviously, the last couple of years have been almost unprecedented, I would say, with the confluence of a global pandemic, geopolitical issues, hotly contested elections in the US and across the world, foreign wars, inflation rearing its head again, rapidly changing interest rate environment, volatile capital markets, and then also just the mainstream emergence of new unconventional asset classes like a cryptocurrency that started as a dog meme stocks that gave hedge funds a run for their money, and of all things, bored apes that fetch millions of dollars in secondary trading. So as you can see, the list goes on and on. So I think we're all familiar with the headwinds affecting PE deal activity and M&A activity at large. But we'll get a deeper dive into those from our experts today. But I would say in order to not sound like complete doubters, we'll also hear about some of the positive tailwinds that people are seeing that can help drive momentum in 2023 and beyond, and just some other interesting developments in the deal environment. So I'm very much looking forward to today's event, to hearing our expert speakers give their perspectives, and to have this virtual event hopefully lead to some dialogue. So like I said, I'd certainly encourage you to ask questions through the Q&A function in the chat here. Now, it's my pleasure to introduce the speakers, and I'll just ask that each just very quickly wave their hand at the screen to make themselves visible. We have Jamie Becker. He's a partner in our private equity and pension funds group based in the Toronto office. Jamie's practices focuses on advising sponsors in structuring and negotiating their private market funds and internal governance and economic arrangements. He also represents institutional investors and leading pension funds with stakes in private equity funds, hedge funds, and other alternative investments. Wendy Berman is a partner in McCarthy Tétrault's litigation group in the Toronto office, where she leads the securities litigation practice. She has expertise in corporate misconduct investigations, shareholder remedies, securities class actions, securities regulatory investigations, proxy contests, and other acquisitions and corporate governance. Stephanie Dewey is a partner in our tax group based in the firm's Toronto office. Her practice focuses on corporate tax planning, including tax aspects of cross-border M&A, corporate reorganization, structuring Canadian operations and investments, and international tax issues. Heidi Gordon is a partner in our Toronto office and also co-head of our national tech M&A group. She's recognized as a leader and top practitioner in the areas of public and private M&A and other capital raising and investment activities. She also has deep expertise representing PE firms and other serial acquirers. Ian Mack, a partner in our financial services group in Toronto. He has a corporate lending practice specializing in all aspects of leveraged finance, banking, and secured lending, and regularly acts for industry-leading alternative asset managers, PE funds, and other financial sponsors. Jeremy Pleasant is a partner in our business law group in Toronto. Jeremy's practice focuses on cross-border M&A, PE transactions, and corporate finance, both debt and equity. Marie Soleil-Landry is a partner in our tax group in Montreal. Her practices focuses on all aspects of tax law with an emphasis on corporate tax and tax planning. She's also involved in developing strategies in connection with a variety of commercial transactions, including public and private M&A and cross-border reorganizations. Lance Williams is a partner in our bankruptcy and restructuring group in Vancouver, providing clients with advice on complex insolvency and corporate finance matters, as well as intricate restructuring issues. So you say hello to the team. Welcome, everybody. Looking forward to the discussion today. So we'll start off with my colleague, Jeremy Pleasant, who's going to provide a brief overview of just the current PE deal environment in Canada. So Jeremy, I think we'll hear today from a number of our speakers that 2021 was a record-breaking year for PE transactions, but we saw a steep decline in activity in 2022. So what can you tell us about the activity that's played out in Canada over the last 12 months?
Thanks, Pavan. Yeah, and as you noted in your introduction, I'll start on some of the down points so we can get more positive as we go on. But it was a busy 2021, but we've seen steep declines since then. And in our 2023 private equity outlook publication, we presented our figures for 2022 as of the time of writing, which is about mid-December. So we've since updated those figures to cover off the last final weeks of that year. And so last year, we saw a considerable decline in the amount of private equity capital that was invested in Canada in 2022 when compared to 2021. Invested PE capital came in at approximately 13 billion based on disclosed deal value, which represented a 40% decline from the 21 billion in the prior year. Deal activity also declined. It came in at about 525 transactions closed at the end of the year, which was a decrease from the 598 deals that closed in 2021. However, on those stats, 2021 was a record high, and deal activity in 2022 did finish above pre-pandemic levels. The year also ended on a lighter note with only $600 million of PE capital invested, compared to almost $4 billion in Q4 of 2021. Overall, Q1 and Q3 remained relatively consistent year over year, but Q2 and Q4 reflected fairly steep declines in terms of both deal value and activity. Looking behind the numbers, when viewing the data based on sectors, the energy sector, IT sector, and B2B sector far outpaced all others. The energy sector saw the most significant increase, with approximately $7 billion invested last year, up from $1.5 billion. The IT sector saw approximately $2.4 billion invested in 2022, which was down 45% from the year prior. And the B2B sector saw $1.4 billion invested, which was down 77% from 2021. However, the total deal count in B2B led all other sectors, and it actually ended the year up 18% versus 2021. And although 2021 marked a reversal of the historical downward trend we've been seeing in PE-backed exits in Canada, in line with the broader trends for the year, the downward trend did return, and PE-backed exits decreased significantly in 2022, being down 27% in total activity and 47% in total value.
And so, Jeremy, we hear about the steep decline in both deal and maybe even fundraising activity in 2022. So what do you think 2022 deal activity can tell us about what activity may look like in 2023?
Sure. So there's a few things I think we can highlight here. One is that, as you mentioned, a lot of the focus has been on the significant decrease in fundraising for traditional PE buyout funds. So those funds outside of the private debt, real asset, or secondary space. And fundraising for those traditional PE buyout funds did dramatically decline in 2022. As of mid-December, that figure was hovering around $1.6 billion in capital raised, and that amount only reflects 10% of the total capital that was raised for similar funds in 2021. We continue to wait and see if the fundraising market will return. However, as a result of 2021's record-breaking fundraising environment, PE firms still had substantial capital to deploy going forward. We still expect sponsors will continue with a cautious and disciplined approach heading into the second half of the first quarter, and for PE investors to generally be a bit more judicious about where and how they're spending their money. We also think funds will continue to closely monitor the public markets and look for opportunities there over the next few quarters. One area that remains a bright spot in the Canadian markets is with respect to bolt-on transactions. So add-ons continue to account for about the bulk of the private equity buyouts in Canada. By their nature, they account for a smaller number of total deal value, but they represent approximately 75% of all PE deals by number in 2022. That percentage is as a result of an increasing trend the Canadian market has seen over the past 5 to 6 years. So as funds continue to specialize and build expertise in specific industries, and with the potential opportunities for firms to acquire distressed assets, we expect to see continued growth in the number of add-on transactions going forward in 2023.
Thanks, Jeremy. So turning it over to my colleague Lance Williams, who's part of our bankruptcy and insolvency group. So Lance, I think what was always interesting to me, or what has been interesting, is that we're starting to finally see that some of those distressed situations play out. We saw it in 2022, seeing it in early 2023, even though we probably expected something like that in 2021, in 2020, in the early days of COVID. And so it's been a bit more of a delayed reaction. So with the more distressed market, what opportunities are you seeing for parties looking to deploy capital?
Uh, Thanks, Pavan. I guess, first of all, what I would hope everybody takes out of today is that the insolvency lawyers and the insolvency regime is not the grim reapers, and that there are a lot of opportunities in a hardening market. The three things I would really highlight would be we are going to see and already seeing more entities going through a sales and investment solicitation process in an insolvency, both formally and informally. And these are used to, in theory, solicit interest in sale or investment, although they're almost always sale. And in insolvencies, these are very truncated processes with varying levels of quality in the data rooms. There's often a lot of pressure from secured creditors to move things quickly. And so there's a real opportunity there for groups that are able to deploy capital quickly, deploy their due diligence team, make quick decisions, because they have advantages over the other buyers, whereas it would be more competitive in a longer process. If you're able to act quickly and deploy quickly and make a decision quickly, you can pick up some deals because you have less competition. Another major opportunity that comes about through insolvencies, and we're seeing more of our go private transactions, so taking pubcos private. What you can do in an insolvency is you can avoid shareholder votes and compensation to shareholders if the company is insolvent. And so the regime can be used either through vesting orders, reverse vesting orders, which is an anomaly that has popped up in Canada, or plans of arrangement that cancel the existing shares and take companies private. So we're seeing that materially simplify the go private process, offering a good opportunity when you're dealing with insolvent pubcos. The third big opportunity is on the financing and the loan to own side of things. Traditional lenders are, of course, becoming more risk adverse. They're looking to get rid of their loans and their security. So there's the opportunity for the prudent investor to go in, buy out the existing bank debt, and restructure it or use it as leverage in terms of dealing with a target company. So a lot of opportunities there to buy at a discount and then use that as an advantage.
And so, Lance, moving away from maybe deploying capital, we have a lot of sponsors and LPs and founders on the line here. And so for parties just holding some of these distressed assets and investments, what opportunities are there in Canada to restructure those in a down market?
Yeah, so there's a lot of opportunities to pop up in a down market to renegotiate, but also renegotiate with a bit of a hammer through the insolvency regime. So generally, your investors, landlords, suppliers, etc., are more willing to negotiate and see the downside of the distressed sale or liquidation alternative. So on the soft side, negotiations are easier. But there are also a number of powerful insolvency tools through the regime that allow you to disclaim unprofitable contracts, disclaim leases, downsize operations, otherwise restructure the balance sheet, and through a plan or otherwise end up paying cents on the dollar for the claims that arise under that. So there's a lot of powerful tools for right-sizing an investment, right-sizing operations, and getting rid of unprofitable contracts and leases for good value. Ultimately, plans, when they go before the creditors in the court, they need to be better than a liquidation. In a distressed market where liquidations are less attractive and there isn't a lot of competition, liquidations look bad. And what that means is your plan does not need to be as generous, and it's easier to restructure at a lower cost and right-size the business.
Thanks, Lance. So maybe just continuing on with that theme around the credit environment and credit conditions. So turning to my colleague Ian Mack from Toronto. So Ian, I think I mentioned this, obviously an interest rate environment that we haven't seen in quite some time. On top of that, just tightening of lender balance sheets, just in response to liquidity needs, just internally even. So given this current impact on changing credit conditions, are you seeing any changes to credit terms and deal structures in the private equity acquisition finance space?
Thanks, Pavan. So definitely. So a few points to highlight on that front. So I would echo the cautious and prudent deal environment that I believe Jeremy echoed earlier. We are still in an inflationary environment. There is uncertainty around rates still to this point in 2023. In terms of credit terms, you're definitely seeing shorter loan terms. So there's a preference for shorter loan tenure. 3 to 4 year deals are quite common, and 5-year deals are less frequent, and there's some hesitancy around approving 5-year deals. In terms of interest rates, we've all, seen the 400 and 425 BIP increase in the overnight rate over the last year. So interest rates are definitely increasing, but the margins themselves are increasing as well, or at least becoming more of a focus with respect to attracting syndicate members. On the flip side of that, interest coverage ratios are definitely coming into focus with the higher debt service payments that are becoming a reality for a lot of the floating rate debt that's out there. Another point, Pavan, lenders are approaching deals with higher leverage multiples, I would say conservatively. There's less motivation and the general sentiment around high leverage is not where it was in 2021, for example, where, stretching for that additional half a turn or quarter turn of leverage was more common. EBITDA and cash flows, mentioned that quickly. In terms of distributions and paying out distributions to shareholders and dividend recaps, which are incurring more debt in order to pay a dividend to the sponsor, those are probably few and far between in the current environment as compared to years past where it was a much more bullish PE environment. So anything where there's cash moving out of the business, including CapEx spend to investments, are drawing more prudence and scrutiny from lenders. In terms of just general due diligence process, I would say lenders and banks are performing more thorough due diligence with respect to acquisition financing, as credit approval processes are definitely more disciplined in the current market conditions. I would just summarize it as lenders being more selective and careful on deals. And I think the last point, Pavan, I'll mention on this point is sponsors and lenders working together to modify or restructure deals. So anything from restructuring or loosening financial covenants or loosening covenants in exchange for increased amort or deleveraging upfront. We're seeing a lot of that, especially in the early part of 2023. And then on the flip side of that, some well-performing companies, so sponsors with well-performing companies are taking the opportunity to lock in terms and extend to reduce refinancing risk. So those are some of the major changes and themes we're seeing, Pavan.
Okay. And so Ian, moving beyond what we've seen in the market and looking forward now into 2023, and we have lenders and borrowers on the line, and then obviously service providers and advisors. So what are the opportunities that you think lenders are focused on as we move into 2023 in this current environment?
Sure. I'll just highlight a couple quick points. I would say there's a continued focus on high quality credits. Alongside that, familiar names, familiar sponsors, existing platforms, still very bullish with respect to lenders and doing deals with familiar names. So they're quite engaged with these types of opportunities. Again, add-on transactions, tuck-ins for existing portfolio companies are quite robust in terms of deal activity. and lenders are approving, features such as incremental term loans and upsizing term loans to support these types of transactions. And then very quickly, Lance talked a bit about this, take private transactions. We've seen a big pullback in public valuations. So the financing of take privates, we expect to be more prominent as we move into the balance of 2023.
Thanks, Ian. Moving along to my colleague, Jamie Becker. Jamie, you work a lot with funds on formation and some of the structuring of funds. And so one of the terms that I think we heard a lot about more recently is continuation funds. And so it seems like we're seeing more and more continuation fund transactions over the last few years, and something that maybe some sponsors haven't considered or really explored before. So can you explain what those are and why they're so popular these days?
Yeah, absolutely, Pavan. So continuation funds actually are very popular these days. You're absolutely right. They used to be a last resort for sponsors to deal with leftover assets at the end of the fund term, but now sponsors have caught on to their benefits. Most major US sponsors have done a continuation fund transaction, and Canadian sponsors have started to catch on as well. A continuation fund transaction is when a private equity sponsor forms a new fund, the continuation fund, and sells one or more portfolio companies from an existing fund to the continuation fund. The LPs in the existing fund are given the opportunity to cash out their interest in the portfolio companies or roll their interest into the continuation and become limited partners of the continuation fund. The LP base of the continuation fund is made up of these rolling investors and new investors who put cash into the continuation fund. These are lead investors usually who negotiate the price and terms of the continuation fund, and then the syndicate of investors who tend to be more term takers. The cash that these new investors put into the continuation fund uses that to buy the portfolio company from the existing fund, and then the existing fund distributes that cash out to cash out the investors who are cashing out. Continuation funds are very popular these days for sponsors for a number of reasons, including 5 that I'll go through today. So the first is that they're an alternative to a traditional exit through an M&A, sale, or an IPO. Selling to a continuation fund allows a sponsor to get liquidity from or for its investors, even though the IPO market is cold, or they can't get a traditional M&A buyer because they can't get debt financing, or they can't agree on price, or for some other reason. In a continuation fund, the purchase price comes from the continuation, the investors in the continuation fund. So there's our secondary investors or traditional fund investors looking for secondary exposure. So this unlocks a new world of liquidity for sponsors. The second reason they're popular is that continuation fund transactions allow sponsors to hold on to their crown jewel assets for longer. If a sponsor believes a portfolio company has further runway for growth, and they're the sponsors at the end of they're nearing the end of the fund term, they can roll that asset into the continuation fund and benefit from that growth in the continuation fund, rather than selling that portfolio company to a competing PE firm and allowing them to capture the upside. Third, continuation funds allow sponsors to give their LPs optionality. LPs who want liquidity, who want the cash, can elect the cash option, take the cash, and sometimes this even frees them up to make new commitments to the sponsor's other funds, so sponsors like that. LPs who like the portfolio company can continue to hold the portfolio company, sometimes for longer, through the continuation fund. So they have optionality. Fourth, continuation funds allow sponsors to inject new capital into their portfolio companies. A portfolio company may need capital to do add-on transactions, which we talked about are popular these days, and Jeremy mentioned that, or to fund CapEx. The fund may be running up against their concentration limit, or they may have deployed all their available commitments. So the sponsor can roll that portfolio company into continuation fund and set up the fund to have incremental unfunded commitments from the new investors to fund that growth. And finally, continuation funds allow sponsors to crystallize some of their carry. Often the sponsors will roll all or most of that carry into the continuation fund, but they can take some of it off the table, and it allows them also to reset their carry amongst their deal team if there's been changes in the team. So there's lots of reasons that continuation funds are popular tools for sponsors.
And so, Jamie, I could see in 2022 why they would be so popular, especially with valuations coming down and maybe just a slower sale environment. So maybe just less opportune time to actually sell an asset. So do you expect continuation funds to remain popular even in the current economic environment?
Yeah, we definitely expect them to be a prominent feature from here on out. Now that sponsors have discovered them, I don't think we're putting the genie back in the bottle. So for the reasons mentioned, there's many benefits to sponsors, and those benefits apply in the current environment and really any environment. And some of them are more so, like the alternative to the traditional exits through an M&A or an IPO transaction. So the supply side is going to remain strong. The sponsors are going to want to do these. On the demand side, secondaries fundraising over the last few years has been at historical highs. This is one of the fastest growing fund strategies there is, led by larger funds from the traditional secondaries players and new entrants into the space. Lots of traditional PE managers are launching secondary strategies. So this secondary strategy or secondaries fundraising means that there's lots of dry powder in the secondary space that needs to get deployed. And these funds deploy it in, among other things, continuation funds. So there's going to be strong demand and strong supply. So even in this environment, we see lots of continuation funds into the future.
Thanks, Jamie. Moving along to, I would say, one of the more complex topics on today's webinar, Marisa Landry from our tax group is joining us. So on the tax side, Marie, the CRA, the Canada Revenue Agency here, recently clarified its position with respect to loans made by a limited partnership to its LPs, which is a top tax topic that may be of interest for many PE funds with Canadian investors. Can you explain to us why a partnership would even make loans to its LPs?
Yeah, certainly. And as you said, this is quite a technical one. So to better understand it, it's worthwhile that we take a step back first. And so we have to remember that private equity funds are often structured as partnership instead of, for example, corporation, given the particular status for income tax purposes of partnership. Indeed, partnerships are, as commonly referred to, transparent for most Canadian income tax purposes, as well as for many other jurisdictions. So very generally, this means that the income or loss of a partnership is allocated to its partner, who then pay tax on such income based on their respective tax situation. And this allocation takes place for tax purposes, regardless of what is actually distributed by the partnership. An important element of this transparency for a limited partner with subject to Canadian income tax is its adjusted cost base in its interest or its tax cost. The adjusted cost base, amongst other things, sets the limit of what a limited partner can receive from the partnership as a return of capital or a distribution free of tax. So it's an important tax attribute that needs to be tracked. As a result of a timing mismatch in the Income Tax Act between when the income allocation increases the partner's cost and when distribution reduces such cost, a limited partner may be deemed to realize a capital gain where a partnership generates and distributes its profit in the same fiscal period. This can potentially result in double taxation for those Canadian investors and hence has become an important point considered by the private equity funds. To mitigate this issue, partnerships who were seeking to distribute profit in the same year it was generated, so being before the limited partner's adjusted cost base is increased, were often considering instead making a temporary loan to its limited partners. This loan was typically offset by distribution in the immediately following fiscal period, being after the increase in the partner's cost corresponding to its share of the income takes place. However, in 2016, the Canada Revenue Agency stated that it could seek to treat such loans as distribution in certain circumstances, which would have defeated what taxpayers were trying to achieve. So given that CRA in the statement in 2016 did not specify in which circumstances it would seek to treat loans as being instead distributions, there has since been a lot of uncertainty around the use of such loans.
Thanks, Marie. So I see obviously now why a limited partnership may make loans to LPs. So can you now just explain what changed in the CRA's position and guidance?
Yes, for sure. So during roundtables that were held at 2 tax conferences last year, the Canada Revenue Agency provided long-awaited guidance on when it could treat or respect the character of loans made by partnership to limited partner, and what it considered as being an exception to its 2016 statement. So in this guidance, the Canada Revenue Agency listed specific conditions, 5 actually, that must generally be met for it to accept that loans are loans to limited partners and not distributions. So the conditions include that the loan is in respect of profit and does not represent a return of the limited partner's capital. And the loan must also be primarily for the purpose of mitigating the deemed capital gains issue. So in this statement, the CRA reaffirmed that if a loan does not meet all of the conditions that it listed, it may seek to treat it as a distribution, as said in 2016, and may even consider invoking the general anti-avoidance rule to get to a result it is seeking. So the CRA's condition provide for a very narrow administrative exception and remains to quite a bit of uncertainty in their application. So while most private equity funds are likely to benefit from this new guidance, all partnerships are still very invited to consult the tax advisor if they are seeking to distribute profit, again, in the same year it is earned, and to see what other alternative that they could consider if they do not specifically meet the conditions that are listed by CRA.
Thank you, Marie-Soleil. Stephanie Dewey from our tax group is also on the line here. So Stephanie, just continuing on with some recent tax developments, and today on our webinar, we have a number of Canadian LPs that are invested in foreign funds or in US funds, and then also just US sponsors and sponsors abroad. So last summer, the Canadian Department of Finance released proposed amendments to the Income Tax Act in Canada that could change the circumstances in which partnerships are required to withhold Canadian income tax. How could these changes impact private equity funds?
So these changes could broaden the circumstances in which foreign private equity funds that are partnerships may be required to withhold Canadian income taxes. And so they could have significant implications for Canadian investors in foreign funds. So if the rules are implemented as they're proposed, a foreign partnership that has Canadian resident members could be required to withhold Canadian income taxes from certain payments that are made by the partnership, even if the partnership itself has no connection to Canada. So to level set, subject to relief under an applicable tax treaty, Canada imposes a 25% withholding tax that's referred to as a Part 13 tax on certain amounts that are paid by a Canadian resident to a non-Canadian resident. Amounts subject to this tax may include non-arm's length management fees and non-arm's length interest. While Canada's tax treaties may provide relief from Part 13 withholding tax in some circumstances, treaty benefits are not always available, or their availability is not always easily determined. Currently, a partnership is deemed to be a Canadian resident for the purposes of Part 13, so that it may be required to withhold Part 13 tax on applicable amounts if such an amount is deductible in computing the partnership's income or loss from a Canadian source. So this means that if a partnership has no Canadian activities or investments, and so no Canadian source of income or loss, the deeming rule should not apply and the partnership should not be required to withhold Part 13 tax. This is the case whether or not the partnership has Canadian members who may be able to deduct a portion of the amount in computing their Canadian income taxes. So as a result, under the existing rules, foreign private equity funds that are organized as partnerships for Canadian tax purposes and have no connection to Canada other than Canadian resident limited partners are generally not required to withhold Part 13 tax under current rules. The proposed rules would instead deem a partnership to be a Canadian resident to the extent that an amount that is subject to Part 13 tax was deductible in computing the share of the partnership's income or loss that's allocable to Canadian resident partners. While there's some uncertainty, it appears that the rules could apply even where the Canadian resident partner is exempt from Canadian income tax, so that there'd be no deduction. The rules would also apply in respect of certain non-Canadian resident partners who are subject to Canadian income tax, generally here where the amount allocable to the partner would be deductible in computing their Canadian income taxes. In determining whether there are any Canadian resident partners or relevant non-Canadian resident partners for the purposes of these rules, the proposed rules would look through tiered partnerships to the ultimate investors. So as an example, to show how the rules could apply and change the current circumstances, consider a foreign fund that is treated as a partnership for Canadian income tax purposes and has a non-resident general partner, non-resident investors, and a Canadian resident investor. The fund pays a management fee to a related non-resident manager that's resident in a country that Canada doesn't have a tax treaty with. The fund has no Canadian investments or activities. The current rules should not apply to require the fund to withhold Canadian Part 13 tax in these circumstances, because the fund should not have any income or loss from a source in Canada. The proposed rules, however, could apply withholding tax to the portion of the management fee that's allocable to the Canadian resident investor, as well as to certain of the non-Canadian resident investors if they're subject to Canadian income tax. This change could have a significant impact on Canadian investors. Foreign funds could seek to pass on the associated costs, including compliance costs and withholding tax gross-ups, to Canadian investors. And they may also seek additional information from investors who are themselves partnerships about their investors. In this regard, no de minimis rule has been proposed, so that a fund will effectively be required to consider potential Canadian withholding tax obligations anytime it has Canadian resident investors. As a result of this new administrative burden, some foreign funds could also impose higher minimum investment thresholds on Canadian residents. The Canadian Department of Finance is currently considering submissions on these proposed amendments and has indicated that the rules would not apply before a revised draft is released. The timing of this release is unknown, but we understand it may not come this year.
Thanks, Stephanie. Wendy Bourbon from our Securities Litigation Group is on this webinar as well. So Wendy, I think one of the interesting things for me is around ESG. So maybe around a decade or so ago, ESG was considered a risk for a lot of companies and portfolio companies. And so now we've seen that switch and evolve into more of a strategy. So a lot of PE firms are using ESG as an investment strategy. And then, we have volatile capital markets here as well. So resulting in a bit of an uptick in claims and securities related claims. And so what are the key trends you're seeing in sustainability disclosure related claims against public issuers?
Thank you, Pavan. I think what we're seeing is sort of two big trends. And one is curious, which is that we're seeing a rise in litigation even before there are mandatory disclosure requirements set globally. So Canada and the US, as most of you know, have proposed rules out there for enhanced mandatory sustainability related disclosures, but we're already starting to see regulatory enforcement proceedings and litigation relating to voluntary sustainability related disclosures. And that, I think, it reflects what the market wants and what stakeholders want. We saw 10 years ago the importance of ESG as part of a strategy, and I think that just is a continuation. The risk, of course, is that we're going to develop the law around what the requirements are through cases and through enforcement proceedings instead of through the typical rule process. So that's just a plug for regulators to get their act together and get some mandatory standard globalized baseline disclosures in place, because it ultimately creates this kind of perfect storm, both for investors and for issuers in terms of we're in a state of flux as to what's required in your disclosure. And some are in draft, some are mandatory, some are very prescriptive, some are principle-based. So it's a moving target. And it's a real risk to enterprise value because a proceeding, as we see, whether it's an enforcement proceeding or a piece of litigation, starts to impact dramatically an issuer, whether it's reputational, share price, its business operations, its relationships with employees, counterparties, and partners. So in terms of litigation, what we're really seeing is two things. One, the enforcers are coming in even before they've set a regime for mandatory disclosure. And right now in Canada, what we're seeing is warnings. We're seeing a lot of warnings coming out of the Canadian securities administrators about the quality of disclosure, even the voluntary disclosure. So recently they put out their continuous disclosure review in 2022, and they identified greenwash as a significant risk in the disclosure and a lot of unsubstantiated climate commitments, be they net zero or other commitments. And we see the Ontario Securities Commission CEO and the Director of Enforcement making strong statements that they're going to begin to take enforcement proceedings relating to sustainability disclosures. We've seen the Canadian Competition Bureau take enforcement proceedings on misleading statements around sustainability and have indicated that greenwashing is a high enforcement priority, and with Commissioner Boswell even coining a new term, calling it eco-fraud as opposed to greenwashing. The SEC always does things in a more cool way, and they developed a specialized unit. One day maybe we'll develop specialized units here in Canada, but we haven't. And so, and then we've seen through the SEC some significant enforcement proceedings brought against issuers and investment funds for sustainability-related disclosures. We're seeing similar things in Australia and the UK. In Canada, yet we have not yet seen what I'll call a specific sustainability-related enforcement proceeding. We're also seeing what I call the rise of activist whistleblower complaints to regulators. And the difference here, what we're noticing is that these are well-financed, well-organized, well-collaborated or coordinated complaints, both to competition bureaus or regulators across the world and to securities regulators. And so we've seen sort of several high profile greenwashing complaints to the SEC just this year and at the end of last year. So relating to sustainability-linked green bonds and allegations that they're not in fact green bonds because they failed to include scope 3 disclosures, and this was an issuer involved in the meat industry. And another complaint that the SEC is looking at right now involving an oil company overstating its financial investment and commitment in renewable energy resources. That's the allegation. And then whistleblower complaints also by former employees, as we all saw, against a global bank, the investment arm, asset management arm of a global bank, on the basis that they were misleading statements about the extent of their sustainability investing criteria. In Canada, anecdotally, I've spoken to both Canadian securities regulators and American securities regulators, and they're both indicating that their whistleblower complaints programs are receiving a high volume of complaints relating to sustainability disclosures. And we've also seen the Canadian Competition Bureau has picked up on 4 recent complaints to them relating to sustainability disclosures, one against a large financial institution, again, based on its renewable investments, and one against a fossil fuel entity on the basis that saying that natural gas is a clean energy and a renewable resource is misleading. And of course, the coffee pod company that we saw about a year or so ago, because they said that their products were recyclable and it turned out they weren't. And I find that one kind of curious because in addition to a financial penalty, they were required to pay close to $1 million to an environmental organization. So I've often wondered, did that fund the next complaint? But anyways, it's worth taking a look at these complaints because they're showing a level of organization I haven't seen before. And then lastly, a beginning swell of class actions about sustainability disclosures. Again, we've got a few in Canada, quite a bit more in the US, and we tend to follow their trends, and in Australia. So it's something to watch, certainly something to watch in terms of making your decisions about where to invest your funds.
Thanks, Wendy. And so with this uptick in civil actions and class actions, regulatory investigations, whistleblower complaints, for the investors and the investment managers on our webinar today, what are the key implications?
So I think the implications are that you need to, we've mentioned earlier, increase your diligence on a company's ESG commitments and ESG strategy. And beyond the buzzwords, and really importantly, mind what we call the gap between what their goals are and what action plans they have to achieve those goals. We're talking about very long-term goals in many cases, 10, 20, 30 years out, but you need to mind the gap. And so the idea is take a look, see what their plan is behind that, and that they've got a robust system it's not a one and done, a robust system to constantly evaluate and monitor that plan and change it as necessary to take into account the changing circumstances. And then you want to make sure the company is deliberate and has kind of a process-driven approach to its sustainability-related disclosures, and that those, we're not just slapping down labels or jumping on the net zero bandwagon that most of your company stakeholders are demanding. And there's a lot of global pressure to jump on that bandwagon. And then when you're jumping on it, you've thought out how you're going to get there. And that the organization is treating those sustainability related commitments with the same level of scrutiny they do, for example, to financial disclosures and financial forward-looking statements. And then the last thing all litigators say, make sure this company is documenting its process and can defend its process.
Thanks, Wendy. Heidi Gordon is on the line here as well. And so Heidi is a partner based in our Toronto group, is also my fellow co-head of our tech M&A group. And so Heidi, we've been talking about this quite a bit over the last few months, but there's been a lot of buzz over the last few years about falling public valuations and what that means for the public M&A landscape in Canada. So do you expect to see an uptick in PE acquisitions of Canadian public companies?
Yeah, I think as long as stock prices are suppressed and the economy continues to present challenges to management teams, the answer is yes. I mean, the other obvious point is that running a public company is a challenge in any economic climate because of the regulation. Wendy just went through some of that, which hits public companies in particular. And so pressure coming from all different places. So you layer on that and other shareholder activism and the proposition of entering into a friendly transaction with a PE buyer who's going to pay a premium to shareholders today, who can use those proceeds to invest in something else, other suppressed stock, that becomes attractive. And PE buyers can make that proposition even more attractive by offering management teams a rollover component to the deal. And these structures are really seen as a win-win for management teams by both removing the management team from the constant public scrutiny of running a public company, while allowing the management team to stay invested in the target company as minority shareholders along PE buyers. Looking at the sort of data we were able to pull on the Canadian take private side, it looks like about 13% of PE-sponsored take private transactions in the past 2 years offered that equity rollover component as part of the consideration. So I think all of those factors together probably going to continue to see an uptick. But whether or not we see an uptick in interest versus execution on those deals, I think are sort of two different questions.
Thanks, Heidi. So for the Canadian legal regime, so as you know, some of the people on the webinar today are friends from outside of Canada. So is there anything in particular that you want people listening today to be aware of in the context of taking a Canadian public company private that they might not otherwise be aware of because they focused on private deal making or that they focused on M&A deals in the US or abroad?
Sure. So when we get asked to hop on the phone with our friends in the US to talk about what are the key things I need to know about a client, private equity firm in the US who's looking at taking a Canadian public company private, there's sort of two main categories of things we always raise. So the first is the plan of arrangement structure. So Lance talked about that a little bit earlier in terms of being an interesting way to deal with insolvent companies. It's also an interesting and useful way to deal with companies that are not insolvent. So although it's a court-approved process, which often scares people when you first describe it, it's extremely effective. And it can provide a lot of flexibility for acquiring 100% of a target in just one transaction. And it's so effective that the vast majority of Canadian take privates, I think the stat is something like 98% or so, are implemented using this structure. And based on the data I reviewed, it looked like 100% of PE-sponsored take privates last year took advantage of the plan of arrangement structure. And then the second one that we often remind our American friends of is our very specific conflict of interest rule here in Canada called 61-101. And that really, it's too complicated to get into in a forum like this, but I just throw it out there as a high-level issue to be aware of. Can often add an extra layer of complexity and can often trigger things like additional shareholder approval, minority approval vote in particular, and sometimes a formal valuation requirement. And this rule comes up on PE-sponsored take privates where the management is given an opportunity to stay invested, like in the rollover type transaction I talked about a second ago.
Thanks, Heidi. So that concludes the formal part of our webinar. So I'd obviously like to thank all of our speakers for all of the insight that they shared. And so we're going to try to stick to our 1 hour limit, but we did get some questions as we were going through this today. So I'll just you put them out there for the group, just in order received. So the first question, I think, Jamie, this is for you. So you're saying that more continuation funds are becoming more prevalent. So are you seeing LPs insist on rights to participate in future continuation funds or elect to roll over their investment entrenched into LPAs or side letters?
Yeah, we're seeing that to some degree. A number of LPs will request in their side letters priority access to continuation funds that a sponsor is setting up for the fund that they're in. They will, of course, have the ability to roll their interest in that portfolio company into the continuation fund. So that's as a rolling LP. But what they're looking for is priority access to increase their commitment, to get additional exposure to these companies. And remember, a lot of the portfolio companies that go into continuation funds are the crown jewel assets. So these are crown jewel great assets that the investors know, and so they're looking for priority access to these investments. Now they know that the lead investors, the ones that I mentioned that set the terms and the price of the continuation fund, are going to be at the top of the queue. But what these investors are looking for is to be next in line. So the sponsor, their thinking is that the sponsor knows these investors have committed to the sponsor, they work well with the sponsor. So their thinking is that the sponsor should give these investors the first call when they're doing a continuation fund. On the other side of the coin, the sponsor often says, well, I want maximum flexibility when allocating these continuation fund opportunities. They don't want to be pigeonholed into giving them to any particular LP. What we're seeing a lot these days is sponsors using these continuation fund opportunities as kind of a carrot to get people attracted to their platform. So they'll offer these allocation of these nice continuation funds in hopes of getting people to commit to that and then commit to their flagship fund where they can get more fees and carry. So we are seeing that to some degree, and some LPs are successful in getting that. Yeah.
Okay, thanks, Jamie. And this could be a question for either Heidi or Wendy. So have you seen a trend in ESG disclosure strategies from entities that aren't mandated for their ESG disclosure? So for example, not-for-profits and port authorities who wish to access the green capital markets out there?
So it's interesting. I guess the answer would have been more clearly yes a year ago, like when capital markets activity was actually sort of happening. You did see a lot of opt-in to things like green bonds. And so, the disclosure that goes along with that, capital markets activity has actually obviously changed dramatically in the last year. And so I think less on the capital raising front and more on just the opting into disclosure generally. I guess the caution on that voluntary disclosure is to listen to what Wendy had to say about you'll be held accountable for what you disclose, regardless of whether or not you were required to disclose it. So something to think about.
And I might just add in what we're seeing just from a regulatory point of view is, at least in the EU, they're coming up with very prescriptive use of labels such as green or transition, and very almost formulaic requirements to be able to use those labels. We haven't done anything like that yet in Canada when it comes to the use of labels or taxonomy. That's something to watch for.
Thanks, Heidi. Thanks, Wendy. I'll open this up to the group, and this could be for, again, Wendy, Heidi, or Jamie, maybe you on the fund formation side. So for ESG-related due diligence, what are the responsibilities for a fund, and how would or do you get assurance at the bottom fund for their ESG?
I can answer that from an LP due diligence perspective, or an LP perspective at least. So this is obviously top of mind for LPs when they're investing in the fund, and the business folks will do their due diligence on the fund, and they have their processes that they run. A lot of our clients are sophisticated institutional investors, and they have ESG groups that go in and they have their questionnaires, and they have all kinds of things that they look for, and they kind of run that process concurrently with the legal diligence side. What they do in the legal documents that we work with is address it in their side letters. So many institutional investors have a side letter that they put forward on every single fund, and they'll have an ESG provision. and it'll vary depending on what the sponsor or what the limited partner cares about. But things that they touch on often in those side letter provisions are they want the fund to fill out annually an ESG questionnaire. So they have their form of questionnaire and they want the fund to give it back to them annually. They might have ad hoc reporting if there's an ESG incident. So the fund will have a contractual obligation to report to them if there's some sort of incident in one of their portfolio companies. They might have annual meetings or quarterly meetings on ESG initiatives. And also they might want assurances that the sponsor is signed up to the UN principles of responsible investing and those kinds of organizations and industry frameworks.
I might add to that is, we thought originally there might be uptake on ESG ratings as a way of satisfying yourself. But because it's just really so highly unregulated right now when it comes to ESG ratings, I'm not sure about the reliability of them. So I haven't seen that uptake as a way of providing an extra layer of assurance.
Thanks, Wendy. Thanks, Jamie. So we have a tax question. Not surprisingly, that's where I have a lot of my questions as well, just naturally. So I think, Wendy, this might be for you. It's on the guidance on LP loans, or whether they're considered taxable distributions. So you mentioned the CRA's come out with these new conditions that partner loans be made in respect of profits and to mitigate the capital gain issue you discussed. So how does the fund actually evidence this to the CRA from a practical perspective?
I mean, that's a good question. Obviously, those statements were made in the fall, so they're still quite fresh. And when we take a closer look at the conditions that were listed, they're open, like I mentioned, to quite a bit of uncertainty. So it would have been great that they come with some form or certificate or whatnot, but it's not to be expected, obviously. These are just administrative statements. So it would be very surprising, yet impossible almost, that we get something in the nature of a form or prescribed conditions, really. What a fund can do, however, is make sure to document the loan properly, make sure to that the conditions are met in each circumstances that may vary even from year to year or from investor to investor. And lastly, there were some of the limited partnership agreement that in the past included already some language providing for loans to limited partners in certain conditions. So it may be the time to revisit those provisions in the partnership agreements and maybe amend them to make sure that the intent is there, that the conditions be met and the circumstances be well limited in the partnership agreement itself.
Thanks, Marie-Soleil. And I think we have time for one quick question before we wrap up here to try to stay on time. So this, I think, Ian, this is for you. So are unitranche lenders in the U.S. still relevant for a borrower in the current market environment, cost of funding or otherwise, versus standard lenders, knowing that the high leverage appetite has materially decreased?
Right. Yeah, sure. I mean, unitranche is there's been a steady rise in a robust market, in particular in the U.S., less developed market here in Canada. And I would expect the unitranche market to continue to be robust, in particular with a more emphasis on direct lenders and with that unitranche financings, as opposed to traditional bank financings where the deals are bespoke and may not fit into traditional bank financings and syndication processes. So probably would create an opportunity for unitranche, given those types of solutions are not easily fit into a traditional bank underwriting process.
Thanks, Ian. So I see we're at time here, and so I personally would obviously like to thank all of our speakers here today. I work with my colleagues very closely, but I was awestruck when they speak about complex topics like these. So thanks very much to all of our speakers. Thanks very much to everybody who joined us today on our webinar, and for this will be sent around by video as well to those who couldn't make it, if you have colleagues who would want to watch this as well. We'd love to continue the discussion with you offline if we didn't get to your questions, so feel free to reach out to any of today's speakers directly. Our contact information can be found on our McCarthy.ca website. Also, there's a link at the top of your screen to a short survey. We'd appreciate if you filled that out just to provide us with your feedback and let us know what topics we can bring you in the future, whether it's through the webinar or our annual publication that are of interest. Lastly, just an administrative note, you'll all receive an email shortly, which will include, like I said, the link to the webinar recording, as well as accreditation information for those of you claiming CLE credits. For those of you in New York, and we know a lot of you are on today claiming New York State CLE credits, the code for today's program is PE021423. Again, PE021423. But that code will also be included in the email you'll receive. So again, on behalf of all my colleagues here on our webinar today, and on behalf of our firm, thank you very much for joining, and have a great rest of your Valentine's Day. Thank you.